No time to analyze the balance sheet? Here's how you can spot the red flag at a glance. Hi, my name is Yuan Chen. I was previously a stockbroker and I now own an investment education company. So head over to this website called physical.ai. Head over to the financials. Click on the ratios and head over to the financial health. These three metrics that I'll look out for. Number one, debt to equity. Now I want the debt to equity to be lower than 0.8. Now why is that so? Because if the debt to equity is 1, so a debt to equity of 1, this means that all the equity in the company is actually funded by debt. Or the debt has actually matched the level of the company's equity. If the company may not have funds to pay off its debt. And if that happens, the company may have to sell off its existing asset or borrow more to pay off the interest. And next what we'll be looking at is called the current ratio. We want the current ratio to be anywhere around 1.5 times. Current ratio helps us to understand that any assets that is within a year can pay off any bills or liability within a year. So if it's 1.5 times, it tells us that the company has more buffer to pay off all the liabilities within the year. Next, we want to look at EBIT over interest expense over 5 times. Now, what does this figure mean? So whenever a company borrows money and the company has debt, the interest expense is something that the company needs to pay off from the profits that they have. And EBIT represents the company earnings before interest and tax. So if the EBIT over interest expense is actually 5, this tells us that the company current earnings can pay over 5 years of the interest that the company owns. So at one glance, with these three metrics, I will know whether the company's balance sheet is actually healthy and is able to pay off its debt. Let me know in the comments if this is useful to you.